Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, February the 18th, 2025, recording this about 7 o'clock in the morning. Okay, so let's have a look at a few things. I think there are like sort of three or four interesting things which happened over the last 24 hours. Of course, the US cash market for equities was closed yesterday, but the futures were open. So it's difficult to read the sort of the price action yesterday. One thing which got my attention was that Trump mid-afternoon yesterday actually released this I want to say a press statement, that would be too formal, a tweet on his Truth Social, which I actually thought was relatively aggressive in terms of the rhetoric, and he basically reiterated the idea that the reciprocal tariffs will be coming, that they're going to involve a VAT, etc., etc. It is fair to all. No other country can complain. And in some cases, there are no tariffs if you manufacture or build your products in the US. The point here is that Trump, I thought it was an unusual timing. The market is closed. It's the President's Day national holiday in the US. And yet he decided to release this in the middle of the afternoon to kind of ramping up or doubling down, pick your cliche, on this idea that the US would be imposing tariffs, they would be reciprocal, and that they're coming, and it's just a question of studying the technicalities of it. The market didn't react to this at all. And if we actually look at some of the risk on sort of assets, let's have a quick look here. I mean, we can look at just to look at like the ES, look at the equities. So the futures were open yesterday, and you can see this morning, they didn't do much yesterday, but you see this morning they're pushing up maybe like a triple top here, pushing into new time highs. So the US equity market pretty happy. You can see this, the Nasdaq doing well. Again, it's the usual situation in the equities that the small caps are lagging. So look at the Russell here. Look at how much this is lagging, and then look at, let's say, the equal weight RSP. Also, pretty weak. And even the MAGs here, the MAG 7 sort of ETF, this is MAGS, in some kind of sort of flagging or sort of a pennant kind of formation here, which could be pushing up. But the point is that risk assets, as I was saying yesterday, still outperforming bonds, still pretty solid. And I'm just curious at what point. And even you look at, for example, emerging markets. So I just want to look at the emerging markets ETF, EEM, which I do believe I have here somewhere. So you look at emerging markets, that's been doing pretty well. And we see in the pre-market, that's up a little bit. And so it's just interesting to me that Trump can put out a very aggressive, quite detailed for him, quite detailed tweet saying that reciprocal tariffs are coming, they're necessary. America will tariff countries, and we're just studying it. And the market essentially completely ignored it, which I think is interesting because it's either a case of the boy who cried wolf, and the market just doesn't react to Trump anymore, which seems to be what's happening. But I just wonder if the market's getting a little too complacent, a little too comfortable, and we could be in for some shocks. Maybe at the end of March or early April, when the U.S. Trade Department is scheduled to report back to the White House, to the Oval Office, and sort of give Trump, their recommendations. So interesting times. So that's one thing to keep in mind. The other thing, which of course is happening today in Saudi Arabia, being hosted by Saudi Arabia, is fairly senior level talks between Russia and the US. So no Ukraine and no European Union. Interesting to see what's coming out of that. We have Lavrov, the wily old fox, the Russian foreign minister, who'll be there. I think Rubio, the new Secretary of State for the US, will be there. I can't see anything more than sort of preliminary sort of roadmap kind of agreements coming out of this. I mean, I don't think today, obviously, we're going to get some sort of end to the Ukraine war, but it's going to be interesting for sure to just read the temperature in the room, to get the headlines, see what's going on there. And also just in terms of the oil market, because it is in Saudi Arabia, is this some kind of, sort of grand bargain between the Saudis, the Russians, and the US, which essentially is sidelining Ukraine fairly shockingly, and Europe, and basically some kind of energy arrangement that, sort of the US will do sort of LNG exports, and the Saudis will do this, and the Russians will do that. So pretty interesting. I don't have any inside information about that. I'm not at that meeting, but for sure, that's an interesting one to see what's happening. And I think the broader picture here, again, is this idea that Russia and the US are very, very keen to get some kind of relatively quick deal on Ukraine, and that America is willing to do the dirty work and basically throw Ukraine under a bus and sort of support Russia, annexing a little bit of land, sort of Russian-speaking land in southeastern sort of Ukraine in exchange for what? Interesting as well that we in a similar kind of situation here. We had the other part of Europe, so we had the European Union leaders meeting in Paris with Zelensky, and Zelensky essentially said, "Hey, no deal with between Russia and the US without Ukraine participation." And so what's interesting here is that it does seem for the first time in about like a kind of 70, 75 years that NATO is generally under pressure. The Atlantic alliance between the US and Western Europe is under kind of some pressure. And Trump and Rubio and that pretty incredible speech the other day by J.D. Vance would seem to support that there's definitely less emphasis or guarantees from the US. So what that means also in terms of markets, and again, pretty interesting. A lot of European sort of thought leaders yesterday were coming out with the idea that they will definitely have to start spending more and more on defense. So obviously defense stocks, Rheinmetall, BAE went up in the European Union, up 10, 12%. But also this idea that have to be some kind of joint issuance for Eurobonds. Now, this is going to be complex because it's one thing to say, oh, we'll do joint issuance of Eurobonds. Of course, at the moment, it's just sort of national bonds. We don't have this supranational kind of bond. So that's going to take at least 6 or 8 months. But it was interesting just to look at what happened in Germany yesterday. You can see, let's say, the front end of the curve. The Schatz didn't go down too much, but as soon as you start getting out to the 10-year, so you had a pretty aggressive sell-off, and if you go out to the Buxel, the 30-year, a big sell-off, and you can see that the curve steepened. If I can try and find that here, let's say like the 30s, the 230s in Germany, you can see that there was kind of some steepening yesterday. And this is just on the idea that, this issuance would probably be more sort of a 10 or a 30-year bond, a lot heavier issuance. So therefore the price going down, the yield going up, and the yield curve steepening, just in this idea that most European countries spend between 1 and 2% of their GDP on defense. US is about 3.5. And basically the Europeans are saying, hey, we all will probably have to adapt to the new reality that Trump and the Americans are not here to bail us out, and that we will have to spend 3 or 4 or 5% of our GDP, which implies where does that money comes from? It's not going to come from, raising tax. It's not going to come from sort of cutting social security spending. That money will come from some kind of issuance of bonds, and therefore that's why we see the reaction in the bond market, especially the German bond market in the bonds. So interesting to see here. Let's say the 230s, if that continues to bear steepen, if actually on the outrights they start to push up, and this also ties into what's going on this weekend, because I'm just going to grab some Earl Grey. We have the German elections, of course. That's going to be very complicated and interesting. But the bottom line here is that the front runner from the Christian Democrats, a gentleman called Friedrich Merz, he came out yesterday basically saying that, if necessary for extra defense spending, there would be the possibility to adjust the debt brake. Now, the debt brake, as in like handbrake, is something in Germany that, the national debt can only be a certain percentage of GDP, and it's pretty fiscally conservative. He said that he'd be willing to change that in order to start issuing more debt to pay for more defense spending. But the thing is that requires a 2/3 majority in the German parliament. So even if the Christian Democrats, Friedrich Merz actually gets into power, he's probably not going to have an outright majority. So he's going to have to do some kind of deal with maybe the Greens. And of course, you have the AfD, the AfD, which is the sort of the I don't know, let's call it the very conservative right wing, maybe even neo-fascist kind of party, which is threatening to get 25 or 30% of the vote. So that's going to be very interesting as well to see what happens on the German election, also in terms of just how the Bund reacts. And you'd have to say that if the Christian Democrats come away with a clear majority, which is low probability, maybe the Bund is not going to like that, because he's definitely said that he's willing to spend more money and open up the deficit a little bit and to undo that sort of legal debt break. So anyway, interesting times in Europe over there. But at this point, the euro is interesting because we start looking about, the Americans being less willing maybe to come to the aid of Western Europe, willing to throw Ukraine under a bus, and willing to do a sort of a side deal, so to speak, for a quick compromise with the Saudis and, let's say, the Russians. One would think that there would have been some kind of reaction, let's say, for example, in the euro. But if we actually look at the euro chart here, doing pretty well. I mean, it had a pretty strong reaction, coming up to some resistance here as we thought it might, going into this trading box, which is kind of the lilac-colored box here at 105. But you've got to say at a certain point, I mean, this morning we had the ZEW confidence surveys, which were, quite good. They were sort of higher than expected. But you've got to say, at what point is this, extra debt issuance, geopolitical risk, or can we say, in fact, it's the opposite of geopolitical risk because there might be a deal? So interesting to see if the euro has enough energy to get up there this morning. Other things which is interesting, for just talking about the dollar and whatnot, we're starting to see the dollar index push up a little bit, but the dollar actually pushing up more. We see the dollar up a little bit against the yen. Let's have a look at the Swiss franc up just a little bit. And that could also be because one of the other interesting things we had actually from Sydney in Australia, a governor of the Fed, Waller, giving a keynote speech, which actually was relatively sort of hawkish. And let's just look at see what's priced in by the Fed at this moment. And he basically said that inflation, the FOMC, that the Fed could still cut this year, but if inflation came down, he was basically saying that inflation is sticky. He would need to see a lot of data essentially showing that inflation is coming down. So at the margin, neutral to hawkish, slightly hawkish. Let's call it a soft hawkish kind of sort of comment. And keep in mind that Waller in the past has been relatively dovish. So you'd have to say that he is definitely signaling that the Fed is on hold, probably at least for a couple of meetings, until and unless we get significant sort of weaker readings on inflation. But probably really the only thing at this point which would really move the Fed to act relatively quickly in terms of cutting would probably be some significant sort of weakness in growth. So we'd have to see some horrible employment prints and maybe, like GDP prints really pushing down lower. And as you guys can see here, if we look, let's say by the December meeting, at this point, we just have 1.5 cuts still priced in. So still 1.5 cuts. But what's interesting is that we have to push out the first cut is not really priced in until the middle of September. 1.1 cuts, about 28 basis points. Keep in mind the usual cut is 25 basis points. So the point is here for the next 1, 2, 3, 4 meetings, like sort of 8 months away, the market is not pricing in any kind of movement from the Fed. Okay, so what does that mean? That means that probably stocks, maybe that's not bad news. The stocks can say, hey, we've priced in, we've already got 100 basis points of cuts. We're getting maybe a peace dividend if there's a quick deal in Ukraine. The Fed is certainly not going to be hiking, and rates at this point are kind of stabilizing. So we're seeing quite a sort of just a stable situation in the rates. And I think the front end of the curve, again, if we look at that, just look at let's say for example the 2-year yield, which I'll bring up here. If I can find it. Yeah, so we look at the 2-year yield here, or even the 1-year yield. So you can see here the 1-year yield's pretty flat. There's not a huge amount of sort of movement in the 1-year yield. You see it's gone up a few basis points over the last few days, just maybe reflecting a little bit Waller's comments. And if we look at the 2-year yield, pretty much still in the box. I mean, can it go up 10 or 15 basis points? Yes. Can it go down 10 or 12 basis points? Yes. But as I was saying yesterday, probably the main action here is going to be at the longer end, like the 10-year and the 30-year. That's going to react probably just to growth data at this point. Any strong growth data that might sort of go up a little bit in yield, and conversely. The other interesting thing was yesterday we saw Jack Ma from Alibaba having a very, very public handshake with President Xi Jinping of China. And that was almost like a symbolic sort of welcome back to the tech sector. So I just wonder, with the potential for sort of tariffs and whatnot, that was a very public embrace of Jack Ma, who had been sort of banished because of malfeasance by the Chinese authorities. So it seems as though Xi was trying to sort of signal to the tech sector and the global and the world, and probably the US, that they have techs back. And it's just interesting here to look at K-Web, which is the Chinese, large cap internet kind of stocks, really doing pretty well and actually gapping up yesterday. I don't know if that was the Jack Ma thing, but if you look at K-Web and you look at that, let's say something like QQQ, let's say the US, like the NASDAQ, and divide that by K-Web, it's kind of interesting just to look at their relative performance here. And you see that the QQQs in the last, couple of weeks or so, 2 to 3 weeks, has really underperformed the Chinese internet stocks. So anyone interested in sort of internet stocks, any sort of dips here, it looks as though, the market quite likes it, but also probably even more importantly is that the Chinese authorities signaling yesterday with that symbolic handshake between Jack Ma of Alibaba that, that the Chinese state is looking to support the tech sector. So that's definitely something kind of interesting to keep an eye on. Okay, guys, so let's look at a couple of other things. What I want to look at as well is we had the RBA last night. So the RBA, let's just go to the Aussie dollar. So the RBA cut 25 basis points as expected, but we had a little bit of US dollar strength across the board on the back of Waller's comments. Waller last night was speaking, I think it was 8:30 p.m. our time, so that's about lunchtime in Sydney in Australia. So if we look at the Aussie, it didn't really have a huge pop. It popped just a tiny bit. If we look at, let's say, the 3-minute chart here against the US dollar, you can see here when the decision came out at 10:30 p.m. our time, it was considered a bit of a hawkish cut. So they cut 25 basis points, which, by the way, is the first time that the RBA has cut in 4 years. So it's really one of the last of the developed market central banks to cut. But the thing is that in the statement and also the press conference of Michelle Bullock, the governor, she essentially said, "Listen, the economy is doing okay. Inflation is still pretty sticky. We still have an inflation kind of problem. We're in no rush, really, to be cutting in, a regular or dramatic fashion." So it's interesting on the 3-minute chart here, just to look at what the AUD did. Whoops, my seems disconnecting. Why is it disconnecting? We had a nice little pop, and then basically, look, this is very annoying. I don't know why this is. Maybe someone's hacking into my account. Anyway, the point is here, the Aussie dollar finding it difficult to really have a sustained move. It's already moved quite a long way in the last in the last couple of weeks here. So, but now we're getting up to a little bit of resistance. This is the big trading range, which is going back for a long time. And I just wonder now, just in the broader sense, is that with the US dollar, it's had a nice sort of sell-off. If you look at the dollar index, the US dollar has, given back, quite a lot over the last 3 or 4 weeks here. And as I was saying, this level around about 106, 105, I think it's going to find a little bit of support here. There is some horizontal support. I don't really know that the US dollar wants to collapse back down into this trading range, in which it had been trading for a long, long time here. And you've got to say, with a Fed which is still clearly on hold, and Waller told us again that they need to see many, many, many months of data. We have the Fed which is on hold. We have a US economy which is doing quite well. We have the US president tweeting yesterday again that he does want to do reciprocal tariffs, which, all things considered, should be a little bit risk off and positive for the US dollar as well, and slightly inflationary perhaps. So I think here we could see the US dollar maybe not ripping higher, but certainly holding its own. And that also comes in the back of the fact that how much is priced in for things like Europe. And what I'm looking at, I mean, I just want to show you something. For example, if we look at the euro zloty, which I do have here somewhere, this is actually from yesterday. Where are we? Yeah. So if you look at the euro zloty, this is a daily chart here. And the reason I've got the Polish zloty here is this whole idea of, what's going to benefit from a peace dividend or some kind of peace deal in the Ukraine with the Russians. And you can see here that this has actually been, very, very strong against the euro for quite a long time. This is a daily chart here. So what I'm trying to say is, I just wonder how much is already being priced in. The euro had a little bounce. The zloty was doing well. And also, if we just look at euro stocks here, so we look at the FESX, the Euro Stocks 50, not the 600, the 50. I mean, just having a little bit of a pause today. This is a very big overhead resistance. See this horizontal going back to about the year 2000 or so. I mean, I've got my forward little sort of projection here. I don't know if this can pop a bit more, but I just wonder, this is almost going a bit parabolic here. And we see also in the DAX, very, very strong, also semi-parabolic here. The DAX, of course, the German index. I just wonder if the market has got ahead of itself a little bit. It's priced in defense spending now. It's priced in a peace dividend. But I just think maybe it's priced in as sort of a stronger euro. But I think, maybe a reality check could be that this peace deal with the Russians and the Americans and the Europeans and the Ukrainians, of course, is going to be a little bit messy, and maybe at least just a technical pullback. So I'm just kind of very curious to be watching the DAX and the Euro stocks over the next sort of, I don't know, a week or 10 days or so. Let's also see the headlines. To be honest, if there's some sort of grand deal coming out of this meeting in Saudi Arabia, okay, for sure, there could be a bit more risk on, which would be pro-European, pro-defense stocks and whatnot. But I doubt that's going to happen today. We shall see. We shall see. Just finally, guys, just note there's been a bit of a pullback in some of the metals space, but I won't really go into that. I just want to look here. at a couple of things. So looking at the VIX here, you see the VIX here is getting to pretty low levels, not the lowest level. I mean, we had it for a long time last summer down in the 12s and 13 handles. It's now more like in the 14s and the 15s. But the point is that the VIX is looking benign. And as I said yesterday, the move index of bond volatility is pretty low. So all things considered here, I think the equities can definitely, pop their head above and make some new highs. Why not? I mean, it looks as though at least something is happening in sort of Eastern Europe in terms of the peace talks. At this point, there's no specific concrete actions on tariffs, even though Trump continues to kind of shake his finger at us. So I think that we still could be in a bit of a mild risk on sort of situation, maybe with rest of the world outperformance, emerging market stocks doing well, European stocks doing well, and American stocks still very, very expensive. So there's definitely flows happening to those rest of the world markets. But as I say, are they getting overextended? That's really kind of the question. And finally, I just want to have a look at oil. Interesting situation. We have the March contract rolling off. We had a little bit of I don't know if to say a pop here on oil. It's subsequently given it back. There was some downward resistance here. Actually, it's just looking over at my chart on the other side of the room here. It's come down 20 ticks since we've been start talking. So definitely a bit of resistance here. But what's happening with oil, if we look at the shape of the curve, is that the market is sort of sniffing out some kind of deal between the Saudis and maybe the Americans, the Russians. But what I've got to ask myself, here's the curve, is what benefit is it for the Saudis to overproduce? And also just doing quite a lot of research yesterday, it seems no one in the US oil space, in terms of the CEOs of the company, wants to pump more. They don't have the capacity to pump short-term another 3 million barrels, which Besant and Trump want. They just don't have the capacity, and they do not have the desire to overproduce, to push down the price, especially when the price is trading in the late 60s, early 70s. Maybe if the price were at $80 or $90, but not at 60s and 70s. So I'm kind of curious here, this idea, like what benefit is it for the Saudis to overproduce or to produce more? And in fact, yesterday we had some rumors and stories that OPEC Plus was considering delaying yet again their scheduled production increases. So they were scheduled to produce a little more from April, but now they're thinking about pushing that back. So interesting, oil did have a little bit of I don't want to say a little bit of a pop, 50, 70 ticks. Oil is just really trying to figure out what's going on here, neither going too high, but neither collapsing. And you see here, we have the live price here, which is the white one. And you can see compared to yesterday, it's gone up a little bit, but the shape of the curve is still pretty flat. You really want to see this pushing up into backwardation before you get too excited. And if we put it back from a month ago, you can see that, which is the orange line here, just zoom in here a little bit. You can see that not only in terms of outright price, but look at the shape of the curve here. So the front of the curve here, definitely very flat. We really want to see more of this sort of upward sloping backwardation to get too exciting. And that's the same if we look at the CL1 to the CL6 spread. So that's the front contract versus 6 months out. This is a 15-minute chart, so much, much shorter term here on the Bloomberg terminal. So you can see here, has kind of stabilized and is sort of starting to crawl upwards, but you see in the last half hour coming down a little bit, last 30, 40 minutes coming down a little bit here, kind of hanging in there. So oil, again, it's going to be interesting to see if there are any sort of rumors or gossip or even headlines coming out of Saudi Arabia today with this kind of trilateral meeting between the Saudis, the Russians, and the Yankees. We shall see. Okay, guys, I've already spoken far too long. I shall leave it here. In terms of data today, we don't have too much. We have Canadian CPI at 8:30, which will be interesting because we had strong employment from Canada, I think, last week. We also have had a BOC, which has been cutting quite regularly. But I think they're probably getting to a point now where they might want to start being a little more cautious. So it's going to be interesting just to see what the CPI is. Keep your eye on the Canadian dollar. In terms of the US, we just have Empire Manufacturing, which is all things considered second tier, not a huge amount more. The one thing I would say, we do have the minutes tomorrow from the FOMC, but that's a story for tomorrow. Okay, I'll leave it there. Have a great day. And those of you in the northeast of North America, keep warm. Take care.